Hi traders, welcome to Market Outlook, trends, risk events and trade setups brought to you by Vantage Markets. Apologies for the slight delay, just having a couple of technical issues, but hopefully should be all good. And you can see everything I'm seeing and hopefully you can hear me pretty well as well. Yeah, this is a weekly webinar where we focus on the key themes, both technical and fundamental, driving markets at the moment. We'll follow the standard format, so hopefully half an hour or so, 30-40 minutes or so, and we will just check out how markets are trading currently. We'll also then review the key events from last week, which includes a couple of central bank meetings, of course, the RBA, the Bank of England meeting, plus a couple of data points as well. The PMIs were interesting, so we'll look at those. We'll then get into the main events for this week, which are pretty much inflation-based. So we get the US core PCE data out on Friday, the Fed's favored inflation gauge, of course, and we'll also look at Aussie CPI and also Canadian CPI as well. So a fair few things to get through. Not sort of top tier data really, although the inflation data will be of interest, of course, but sort of lesser known, but still very important, especially for the Fed. So markets currently, well, Friday equities, they slipped off their consecutive record highs in the US, especially the NASDAQ. The S&P 500 that added 0.65 on the week, while the Dow rose, interestingly enough, more than the S&P 500 and more than the NASDAQ as well. The Dow rose 1.45%, the strongest showing since the week of May the 6th. Just as I'm talking through the markets from last week, I'll just let you have a look at the disclaimer as well. But interestingly, yes, and we have been putting this out actually on our daily commentary, but the Dow fared modestly better than the other indices, which has been a rare occurrence, as I've said. McDonald's, that was interesting, driving gains in the Dow, building really on Thursday's announcement, actually about a $5 meal deal, and really just generally trying to ramp up cost-friendly options, really. That's what that takeaway is. Tech suffered again, really. Nvidia losing over 3% on Friday, and that was certainly the biggest drag, as it is, of course, the biggest company on the indices, the most valuable. Currencies, dollar slightly off actually after hitting a fresh 8-week high actually against the yen last week. We had US business activity that hit a 26-month high in June amid a rebound in employment while price pressures subsided. Interestingly, the US Treasury on Thursday, they added Japan to a list of countries labeled as a currency manipulator. So we'll see what action that has going forward. The yen was the weakest performer among G10 currencies last week, and dollar yen nearing that significant, well, around there, the 160 level. That is despite increased verbal intervention from the FX chief in Tokyo, Kanda, which really didn't really move the dial on the yen. Key pairs, actually, interesting enough, all those sort of yen crosses, so Aussie yen, sterling yen, even Mexican yen as well. They surpass really important thresholds on the charts. Aussie yen above 106, sterling yen above 202 now, and the Mexican yen breaking its 200-day moving average. Dollar had held near 5-week highs actually versus sterling, so that was its lowest level since mid-May. And certainly as well, there's been a focus on the euro, of course, with the French elections. It did calm down, of course, this sort of French election chaos and those bond spreads that we've sort of highlighted before. So that's the French government bond spread versus the German government bond spread, really. And that gives you an idea, if that widens, and it gives you an idea of the stress that markets think should be priced in to markets in general, really. So everybody's been watching that spread. That widened out to multi-year highs, I think, but just sort of narrowed in the last few days. So just something to watch there. Crude oil commodities, they sold off on Friday, actually, amid concerns really about this general global oil demand growth that could be impacted by this stronger dollar. And of course, ongoing conflict in the Middle East. Brent was actually up around 3% on the week, marking a second straight weekly advance. That's interesting on the inflation side, really, potentially, after gaining about 4% the previous week. Gold, that gave back all its gains from Thursday on Friday, off over 1.6%, back below the 50-day SMA at 23.42. Certainly the better PMI data out of the US, that did for bullion, really. Though it has climbed, let's not forget, around, well, over 20%, around 22%, I think, over the past 12 months. Let's just go to a couple of charts, actually, which is better than certainly looking at the disclaimer, which hopefully you will have checked out. This is the 10-year Treasury chart. Let me just let you see that. Bear with me. Sorry, 1 second. Which is here. Yeah, we like to look at this. This is a global proxy for borrowing costs, essentially the 10-year US Treasury yield. And you can see we're still fairly sort of hovering just around the lows, recent lows anyway, 4.2%. So just watch that as strong support. If we can bounce off here, we've still got that 4.33% marker on there. Always a guide, obviously, for other markets as well. If we then look at gold as well briefly, 23.25 we're currently at, you can see, yeah, the blue line is the 50-day moving average of 23.41. And yes, decent support around 2300 and just below. We've got the low of where the May low, 22.77 as well. So just that sort of zone of very strong support for gold, with a near term upside, probably those recent highs from last week around the 50. Is it the 50%? Yeah, the halfway point of this move over the last few months, that halfway point is at 23.63. Okay, we always look at stocks. Obviously, they've been going higher and higher, but just that stop, or not the stop, sorry, they're just that sell-off on Friday, just above 5,500. You can see there the high 55.05, just closed below, but still obviously a strong uptrend. Nasdaq similarly did sell off briefly. Didn't quite get to 20,000, which we said it probably would do, having broken this sort of 18.9 level. Yeah, so that's interesting whether that proves a barrier. That's key psychological level, if nothing else. And then you can see those consecutive days, obviously, of gains, like we said, which hasn't been seen for quite a few years. But just this Dow bounce in the Dow is interesting, I think, as tech sell off, as tech sells off, sort of industrial value really began to sort of recover slightly from what has been massive underperformance against tech, as we've highlighted. Sort of value investment cycle perspective, quite interesting, makes sense at this time in the cycle as well, but probably too early to determine whether this is a sort of beginning of a trend shift or not. I did read over the weekend about Nvidia, obviously, and whether that first week, down week, I think it is for some time, whether that is a nothing burger or not. Let's just pull up the Nvidia chart just to double check. So you can see it was off 3.2%, and just made a new high, but then closed on the lows. Interestingly, that new high 140 obviously had a split. If we go to consecutive weeks, you can see these just multiple weeks, these green candles here, down here, not candles, but bars really, consecutive weeks of gains, and just slowing up last week. So interesting point for tech for sure. Okay, let's just go to the data now from last week. So first of all, I'll just pull up some of the graphics we like to use. So first of all, just bear with me, just get the graphics that you can see. So we've done, this is just really telling us what we're looking at today. Obviously, just checking out how markets are shaking up for this week. Just checked out the stock indices. We'll now review the RBA, CPI data, and the Bank of England and PMIs. We'll just look at CPI data first. and the Bank of England, yeah, pretty close to expectations. Headline eased to 0.3% month on month. That hit the Bank of England's target at 2%. That was the first time since spring 2021, as I've put on here. Driven down really by goods prices as lower energy prices gradually filter through the supply chain. So food, household goods, clothing, all now contributing really a lot less to CPI than just a few months ago. Core, interesting that, well, eased as well as expected to 3.5% from 3.9. But the big caveat in there, as we highlighted last week in the preview, really was services inflation. And that only dropped to 5.7 from 5.9. So less than hoped for a second month in a row. And also crucially above the Bank of England's May forecast. So yes, that was the kicker really in this inflation report. I'd kind of ignore that headline number as we tried to sort of highlight last week. Ignore that. Focus on services inflation. That's key for the MPC. And really, yes, the Bank of England then still has work to do to bring inflation back under control in a sustainable way. As for the Bank of England, well, let's just check out a couple of charts as well. Yeah, you can just see disinflation trend nicely in progress on the and the core. And you've got this interesting chart from Bloomberg put out there just to see this spike, really incredible spike. This sort of chart focused on the election, and obviously one of Prime Minister Sunak's pledges was to bring down inflation back to 2%, I think, or at least bring down inflation sharply. Kind of has done that, as you can see from this chart, and this massive spike up to 11.1%, I think it was the peak a couple of years ago. And you could just see that relative to these other peaks, quite incredible, obviously. But then this very sharp downturn as well. But that is in headline inflation and essentially due to energy costs coming down. So, yeah, if we sort of go back, you can see that sort of there is the spike, but just a fewer years comparison. That is interesting, but yes, probably not the whole picture for surely for Prime Minister Sunak. But obviously, we then had the Bank of England meeting, pretty much as expected. Minutes really and the statement suggested officials are getting a touch closer to cutting interest rates. They kept rates unchanged, of course, 5.25%, 7-2 vote as expected. No surprises there really, but the statement read a touch more dovish, with the decision really labelled as finely balanced. So that was interesting. And the bank, well, they didn't change its forward guidance, but they said rates need to stay restricted for an extended period. We thought that could be a changer and signal an August rate cut. They didn't do that, but there was some commentary as well on the recent upside surprises in services inflation, as we just mentioned. And interestingly, actually, they sort of looked through those. They said they were attributed to volatility related to annual price hikes and not a significant trend. So the bank may not be drawing too many conclusions from what we've just told you about services inflation, but interesting points, and definitely they are focused on it, but just maybe looking through these high prints at the moment. Certainly they're not pre-committing to anything, as we kind of knew. Are kind of inclined to cut, aren't they? It sounds like an August rate cut now likely if the next inflation report doesn't contain too many surprises. Markets really, they didn't react that much, and it's interesting, they reacted more when the dollar moved really, and then markets sort of priced in from around sort of low 30% mark up to sort of above 60% chance of a rate cut in August now. September fully priced pretty much, so it's whether they go in September now, which then potentially affects the sterling more. We have seen that sold off. Let's just check out the sterling chart, cable that is, of course. So sterling against the dollar, and we did sell off, as I said. So here you can see, let's pull up the daily. Yeah, just the sell off, you can see on Thursday, that big red candle really getting to the bottom of the recent range. and we closed on our lows, so quite bearish really, 126.54. We've got a fib level in there of this move, this April to June high move. First fib level at 126.46, so we're hovering around there now, interestingly enough. So first support for sure. The blue line's a 50-day moving average. That's at 126.27, you can see. So interesting support zone, whether we can hold on to that. But we have, well, we're just about holding on to that recent sort of lows from sort of mid-May as well. So yeah, probably doesn't look too good if we lose 126.27 for sure. And then last week's lows at 126.21, lose that, then we're down to sort of 125.79, which is the halfway point of this move. Otherwise, the 200-day moving average just below that at 125.53. Okay, that's cable. Let's go to the RBA meeting. We'll look at Aussie dollar here. They left policy as unchanged as expected, 4.35%. One of the small meetings, so no updated economic or rate forecasts. And the communication remained mostly unchanged. So they noted, the bank, this is, since the last update, economic growth momentum appears to have cooled further. Unemployment has risen, wage growth has slowed more than expected. But even so, and this is the problem, underlying price pressures remain sticky and uncertain, especially with developments overseas and domestic. And that uncertainty remains high. So yes, it's really this pace of disinflation, so falling prices, has been slower than previously anticipated, really is what the bank said. And still inflation remains some way above the midpoint of their target band, which is 2 to 3%. If you remember April CPI, that was 3.6%, up from 3.5%, and the core at 4.1%. So not really near their target range at the moment, which is disappointing and really means, well, the RBA, to quote them, is not ruling anything in or out in terms of policy outlook, signaled no urgency in terms of cutting rates. And board chair, Bullock, said in her press conference, actually, they discussed the case for a rate hike as well. So mildly hawkish tweaks, really, especially with that press conference comment, an ongoing concern really about price pressures. Sadly, it hasn't really moved the Aussie dollar. If we look at that on the chart here, stuck between this range, really, sort of 66 to 67 still. What can I say? Yeah, watch 66 support again. If we do push higher, then 67 is resistance. So just range trading at the moment in the Aussie dollar. Let's just briefly look at PMIs. Those who were on last week know that I like this matrix, which Reuters kindly puts out. Just these red numbers are above 50, denoting expansion, blue numbers denoting contraction. Not quite updated, apologies for that. But yeah, the Euro PMIs, really the big numbers on these PMIs, weaker than expected. The composite fell very close to 50, actually, 50.8 from 52.2. So that was disappointing. Services sector recovery slowed. Manufacturing recession accelerated, really, after we had seen some signs, positive signs on that front for a while. So disappointing. The index for output prices, actually, that took another leg lower, so slightly more encouraging. But certainly this has been a good indicator for core CPI, HICP, inflation in the Eurozone. So just watch out for that, which was of interest. Okay, moving on to this week. And firstly, preview of US core PCE. So inflation data, really. Here you can see a chart with the main inflation numbers. So the yellow line, headline inflation, blue line, core CPI, and then the dotted line, obviously the 2% inflation target, and then the green line is core PCE. That is the Fed's favored inflation measure, as I've said, essentially because it sort of picks up a wider, broader range of prices. And really, given the inputs from CPI and PPI, really PCE then It looks set to post the second consecutive print at 0.2%. There is actually much hope that it comes down. And if we look at then the 3-figure decimal points, then potentially it comes down to 0.1 something month on month, which will be encouraging, certainly. And especially after the May CPI supercore gauge, which we talked about last week. I think that fell for the first time since October last year. And also the PPI softened as well. So this could all boost expectations of a September rate cut from the Fed. Interesting then whether the dollar loses some support. That's around a 2 and 3 chance at the moment, I think, and around just under 50 basis points of rate cuts priced in for 2024 at the moment in the US. Report, well, consensus, I think now is probably that it lightly reinforces recent messaging about the Fed wanting to cut, and that's why those interest rate chances have picked up slightly to, as I say, around 66% or so. The other data, well, household income data growth is barely growing now in real terms, and consumer spending is cooling as well. So we do get the numbers out on Friday as well with the PCE data. So that'll be interesting for the DXY. You can just see this curve of interest rates, which we used actually last week, but pretty much hasn't changed too much. And just now, the market expecting more rate cuts than the Fed. The Fed just won this year, if you remember, from the recent dot plot, whereas markets pretty much 2 now. So interesting who wins out on that discussion. But obviously, Powell said nothing's cast in stone on the dot plot. Let's just go to the DXY actually now. So just bear with me. This is obviously the dollar index chart. Which is here. And you can just see that pickup in prices actually from, as we've said, around the 104 mark through the 200-day, through the 50-day, which it pulled back to, so acted as support, plus that sort of trend line, long-term trend line, upward trend line. So it's just up and just sort of found resistance. 106 is going to be obviously above, is going to be big resistance. That's the that is the year-to-date highs, of course, at where are we? 106.51, I think. Yeah, 106.51, 106.49. So that is big resistance to this up move that you can see here. But we are above that upward trend line from those lows back in right at the end of last year. And then support should come in around 105.19. So that is our bias at the moment. Just touch upon Canadian CPI. We get that data on Wednesday, I think. Just remember, after Canada cut interest rates, of course, earlier this month, the focus is certainly on this report. Further moderation would lift expectations that the BOC actually could follow up with a second cut on 24th of July. Current market pricing around 17 basis points or so. So times that by 4 is around 68% chance of that 25 basis point cut. So certainly, yeah, softer numbers in the inflation data would really cement that rate cut. Another one around 2.5%, I think, is probably consensus where this should print the main number. And possibly then, if we do get dovish comments from Bank of Canada officials, then certainly it would bring forward that September rate cut, which is more heavily priced in, to potentially that 24th of July meeting. You can just see these consecutive sort of edging down in dollar CAD. So that's CAD strengthening, of course. 50-day moving average of 136.93. So if we do lose that, then we go down to sort of 136.23 really, which is this fib level of this move, and where we found support before in May. Otherwise, 138 is, of course, serious resistance to any move higher at the moment. Also should touch on Aussie CPI. I know we've looked at Aussie dollar. That will be in the spotlight, of course. 0.3% month-on-month decline, mainly driven previously by, well, seasonal declines actually in holiday prices. That could see the annual figure edge higher again, actually, from 3.6%, as we mentioned. Consensus actually sees a May print of 3.8%. And economists say that this month will provide some insight actually into how services inflation is unfolding through the June quarter. Certainly, though, pressure to respond by the RBA with higher rates has to be growing, of course, with these issues around sticky inflation in Australia. Okay, shorter one, but hopefully that's been of interest. Really do appreciate you being on this call, of course. And sorry about the slight delay. If you do have any questions, please do ask them along the way, although we've pretty much come to an end there. But hopefully that's been of use to you guys. Please do follow us on social media. And as I always say, we do post up a daily commentary as well on the website, which features a chart of the day and also a slightly more in-depth look at the day ahead, as well as prices after the US close. So yeah, really appreciate you on here. Please do come again same time next week, Monday, and take care out there, and we will speak to you very soon.